So student, let's start the revision class, and in today's class we'll be inshallah discussing we will be actually revising capital gain tax and IST through questions. Okay. And one more thing, after this class, any other topic which you want me to revise, so obviously then we'll be conducting more revision classes on those topics. So do write in after today's class any other topic which you want me to do revision, keep the revision classes on that topic. So I'll keep classes on that topics, no issue at all. And next week, inshallah, we'll be discussing the ACCA pre-scene mock as well. Edwin will let you know the entire procedure, how we are going to attempt, and the way of discussion and everything. Let's start with the first question. Compute David and Angela's respective total capital gain tax liabilities for the tax year 24-25, ignoring payment on accounts. So basically, you should not be thinking for any payment on accounts. Okay. Let's read the question. Basically, when there is only one scenario in the entire capital gain tax where we have to pay capital gain tax like payment on account, and that scenario is when an individual, when owner is selling the residential property, then you need to pay capital gain tax within 60 days. And that is treated as payment on account. But examiner has categorically mentioned in the requirement that you are supposed to ignore payment on account. This scenario leads to one requirement. David and Angela Broke are married couple. They dispose of the following assets during the tax year 24-25. Jointly owned property. Students, if you recall the concept of jointly owned assets, unless actual ownership is declared by both to HMRC, if this is the case, then gain or loss will be shared according to their actual ownership, provided that jointly they have declared to HMRC their actual portion of ownership. Otherwise, nothing is mentioned. Whatever the gain comes, it is always split 50-50 between husband and wife. On 30th September 2024, David and Angela sold a house for 3,81,900. Disposal proceed. The house had been purchased on October 2004 for 86,000. So straightforward, if I just give you the idea, disposal proceed is 3,81,900. Cost we will deduct, which is 86,000. Let's say it is working one. Obviously, you will be solving it properly. Sale proceed minus cost will give us capital gain, which is 2,95,900. Okay, let's read more. David and Angela occupied the house as their main residence. Students, if the house sold was the main residence, can I say then we should be thinking for principal residence relief exemption. Is that clear? That is a hint to think for a PRR. David and Angela occupied the house as their main residence from the date of purchase until 31st March 2008. So can I say from the date of purchase till 31st March 2008, that will be your actual occupation. The house was then unoccupied between 1st April 8 till 31st December 11 due to Angela being required by her employer to work elsewhere in the UK. Now listen, if you are working within UK and you are unable to occupy your house for 4 years, while working in UK, you are not coming back to your home for 4 years. it is considered in deemed occupation. But there is a condition for that. The condition is it deemed occupation rule will only apply in that case if it is preceded and followed by actual occupation. Preceded we can see. Let's see what about the actual occupation. 1st April 2008 till 31st December 11 due to Angela being required by her employer to work elsewhere in the UK. From 1st January 2012 until December 18, David and Angela again occupied the house. So we can see that there's after working in UK for some times, then they have reoccupied the house. From January 12 until December 18, David and Angela again occupied the house as their main residence. The house was then unoccupied until it was sold on 30th September 2024. If you recall, last 9 months of ownerships are always available as your deemed occupation period, no matter you were not living there, no issue at all. Last 9 months of ownership are unconditionally given to you as deemed occupation. Throughout the period 1st October 2024 to 30th September 24, David and Angela did not have any other main residence. Okay. Now, students, anything else? Just a minute. Okay, fine. Now, students, first we have to calculate the occupation months. Let me show you working 2 here. Actually, principal private residence relief is equal to your gain multiply by occupation period. Can I say, students, divided by ownership period? Calculator is here. Let me first calculate the ownership period. Date of disposal is 30th September 2024. Just I want to show you 30th September 2024, that is date of disposal. Now let's see what is the date of purchase. This house was purchased on 1st October 2004. First October, 30 days, 30 minus 1 will give us 29. 29 normally 29 means 1 month. But look at this 9 and 10. We'll get 1 negative month. Try to understand now. 29 days means 1 month positive. And this is 1 month negative, it will cancel out. Let me deduct this 2024 minus 2004. I'm getting 20. Wow. 20 years. So basically 20 years multiplied by 12. Students, logically the ownership months are 240 months. Actually, this is negative 1 and this is positive 1. It is cancel out. So the ownership period is 240 months. Now let us try to calculate occupation months. Occupation period. From 1st October 2004 till 31st March 8, it is actual occupation. 1st October 2004 till March 2008 is your actual occupation. Actually occupied. Okay. Now I just want to give you the idea, then rest I'll be doing directly. 31st March 2008, 110 2004. We'll get 30. Here we'll get -7. 30 positive means one positive month. We'll get 4 into 12. 4 into 12 gives us 48. We have got 48 minus 7 plus 1. So basically I'm getting 42 months. Your actual period is, occupied period is 42 months. Now it is up to you how you calculate, but I'm just giving you the idea. Now democcupation, while working in UK, someone is not coming to home for 4 years. Still we assume that you are at home. So democcupation period 4 years is available if you are working in UK and not coming to home, but provided that it must be preceded and followed by actual occupation, and that criteria is met. Now let's calculate how many months. From 1st April 8 till December 11. Working in UK, that is democcupation. From 1st April 2008 till December 2011. That is working in UK, democcupation. This is democcupation. Now, if you count the time period of democcupation, it is 45 months. Okay, after that, from 1st January 12 till December 18, it is actual occupation. From 1st January 2012 to December 2018 is occupied. 18. From 1st December 12 to December 18, we have got exactly 7 years if I'm not wrong. And 7 into 12, I'm getting 84 months. After that, what happened from then? What happened? The house was then unoccupied until it was sold. So the last 9 months of the ownership, they always fall in democcupation. They are always considered as a part of occupation unconditionally. So simply last 9 months of ownership, that will fall in democcupation. So here comes your occupation period 42 plus 45 plus 84 plus 9. So occupation period I'm getting 180. Ownership period we already calculated 240 months, which means that very easily we can calculate exempt gain. So less PRR, that's going to be working to 2,95,900 into 180 upon 240. So 2,95,900 multiplied by 180 upon 240. I'm getting 2,21,925. 2,95,900. So the gain amount is 73,975 chargeable gain, and that gain will be split 50-50. That gain will be split 50-50 between David and Angela. Okay, we'll come to that, don't worry at all. . David broke On 5 May 2024, David transferred his entire shareholding of 20,000 £1 ordinary shares to Bend Limited, an unquoted trading company, to Angela. Student, if you recall, can I say if there is the transfer between husband and wife, transfer of assets between husband and wife, it is always transfer at no gain, no loss. Transfer of asset between husband and wife, it is always at no gain, no loss. On that date, shares were valued 64,000. Not relevant. David's shareholding had been purchased on 21st June 2021 for 48,000. Basically, this 48 will become base cost for Angela. So when there is a transfer of assets between husband and wife, it is always transfer at no gain, no loss. So the cost of donor becomes now the cost for the donee. Is that clear, students? Cost of donor becomes cost for the donee. So here basically no gain, no loss. Transfer between husband and wives. Okay. On 7 July 2024, Angela sold 15,000 of 20 £1 ordinary shares in Bend Limited, and that had been transferred to her from David. Sale proceed is 62,400. After just few months, Angela sold 15,000 shares out of 20, which she took, which David transferred to her. Okay, fine. There will be a proper capital gain calculation. Let me just show you working tree here. Shares sold by Angela. They have given us disposal proceed was 60 something. Let's see. Disposal proceed is 62,400. Let me repeat. Cost of David is now cost for the Angela. And that cost was 48,000, but the 48,000 is a cost of 20,000 shares. And Angela has sold only 15 out of 20. So 48,000 multiplied by 15,000 divided by 20 gives us 36,000. Chargeable gain is 26,400 for Angela. Now come here. Neither David nor Angela has ever worked for Bent Limited. This means you should not be thinking for badder, because the question itself says never David nor Angela worked for Bent Limited. Okay. Otherwise, if you recall, if you are selling shares in a personal trading company where you are an employee, ownership period is 2 years, the holding is at least 5%. Then you get badder. Here, badder is not available. On 15 October 2024, Angela disposed of a small business she had been running part-time for many years. The only chargeable asset in the business was a warehouse, and this resulted a gain of 3,700. Student, if you just read it properly, what Angela did here, Angela actually has sold her business, no matter small, big, this is not the question. And she was running this business for many years. Logically, on this chargeable gain, badder is available. Because Angela sold her business. Angela has taxable income 27,145. For the tax year 24-25, David does not have any taxable income. So it means when we'll be calculating CGT for Angela, we have to be very careful when it comes to basic rate band number 1 and number 2. Don't forget one thing. When we have got two types of gain, one, the gain which qualifies for better, another which is not qualifying for better. So number 1, we will be deducting annual exempt amount. If there are any capital losses, we will deduct them from the gain which is not qualifying for better. But when it comes to applying the CGT rate, first you have to apply the CGT rate on the gain which actually qualifies for better. So let us first calculate CGT. I think calculation of CGT for David should be very straightforward. He does not have any income, nothing else. So David is having only one thing, David. Can I say the capital gain is 73,975? 50% of that actually belongs to David and 50% of that belongs to Angela. The amount is, let me write calculator. Capital gain is 73,975. David. Capital gain tax liability. Gain from house, working one, 73,975. Can I say 1 upon 2? 50-50. I'm getting 36,009. Let's make it 88. Otherwise, I'm getting 87.5. Transfer of shares between husband and wife, no gain, no loss. Shares in Bend Limited. No gain, no loss. So it is 0. So the total gain in case of David, we are getting 36,988. Total chargeable gain. Annual exempt amount 3,000. So taxable gain is 33,988. David does not have any other income, so the entire 33,988 actually falls in basic rate band. In case of residential properties, if there's a space in the basic rate band, then applicable CGT rate is 18%. Capital gains tax, 33,988 will take 18% of that. Students, I'm getting 6,117.84. So make it 6,118 with a little bit rounding off. So as far as David CGT is concerned, it's very straightforward. But Angela has got actually 3 types of capital gain. One, the gain which qualifies for better, where we apply the tax rate first. Then she has got gain which is coming from the shares. And third, she's also having a gain from the residential property. Obviously, CGT rate for residential properties, they are higher. So let's calculate Angela CGT liability. Angela CGT. One is the gain which qualifies for better. Gains qualifying for better. Then we have got other gains. I'm keeping gain from the residential property separately because it has higher, I would say, CGT rates. And if I have, for example, obviously annual exempt amount, I should be deducting against the gain which is coming from the residential property. If I've got any capital losses, I should be deducting which is coming from the gain which is coming from the residential properties. We sold house that was working one, 36988. Then we have got another, okay. Shares sold by Angela working 326,400. Disposal of shares in Bend Limited working 3. What is the amount of the gain? 26,400. Then we have got the only chargeable asset of the business was a warehouse which qualifies for cap better 3,700. Warehouse, no more gains, 3,700, 26,400, 36,988. These are your total capital gains, total chargeable gains. Student annual exempt amount should be deducted from the gain which is residential gain which is coming from the residential properties. Why? Because they have the higher CGT rates. In case of a space in the basic rate band, we apply 18%. Otherwise, we apply 24%. So here comes your taxable gain. 3,700, 26,400, 33,988. Now, student, first we have to see. First, obviously, I have to apply the CGT on better. No matter there's a space in the basic rate band or not, let's see. Gains qualifying for better. Gains qualifying for better. 3,700 into 10%, I'll get 370. Now we have to check how much space is left in the basic rate band. Only then we can decide which CGT rate is applicable. Come here. Working 4. Okay. Basic rate band. Basic rate band limit is 37,700 minus the taxable income, which is 27,145 minus the amount on which we have applied better 3,700. So from 37,700, I'll deduct 27,145. I'll deduct 3,700. So I'm still getting the space in the basic rate band 6,855. Still, there's a space in the basic rate band which is 6,855. Okay. Now the question is, which gains should I tax first? Should I go for other gains or residential properties? Always remember, when you have two types of gain, one is gain which is coming from a residential property, another which is not coming from a residential properties. First, try to tax the gain, which and if there is a space in the basic rate band, if there is a space in the basic rate band, then obviously you should first tax the gain which is not coming from residential properties. Repeat, if we have a space in the basic rate band and we have got two types of gain, one is the gain which is coming from the residential property and another is which is not coming from the residential properties, then technically I will apply the CGT rate on the gain which is not coming from residential properties. There's a reason to that. I'll show you the reason. So let's go for other gains. Let's say working, how much working? So I think working 4 or 5, whatever you say. Either 4 or 5, you can correct this. We still have a space of 6,855. Applicable rate is 10%. Now listen, student. If someone, instead of taking other gain, if you take residence, the gain which is coming from the residential properties, then instead of 10, you will apply 18. Obviously, you will end up by paying more tax. So I'll get 685.5. So with a rounding off, you can say 686. Now, from this 26,400, we have applied the tax on 6,855. How much capital gain is left? 26,400 minus 6,855. 19,545. We still have this much. Now applicable rate is 20%. Basic rate band is over. So I'm getting 3909. Now the gain which is coming from the residential properties. Residential property gains. $33,988. Applicable CGT rate is 24% because no more space in the basic rate band. If I take 24% of 33,988, I'm getting 8,157.12. So ignore that 0.12, 8157. So 370 plus 686 plus 3909 plus 8157. I'm actually getting 13,122. Capital gains tax liability. So I strongly believe everything is clear to everyone. If you have any question, any query in this question, you can ask. And meanwhile, I'm just saving this PDF. Then I will share the new question with you. But if you have any queries regarding this question, you can ask. Let me pause the video. I don't want video to be very long unnecessarily. Okay, so let's see another question. Again, it's a 10 marks question. Part A. Calculate the gains arising and capital gains. Calculate gains arising and capital gain tax liabilities for Bill and Billy on the gift of High Rise Limited. Just a minute. No, that's my bad. There's another question. So only the requirement is here. Okay, and then this is also a 10 marks question. Fine. Explain how many £1 ordinary shares in New MIG Limited Ginger can sell to her daughter for £4 per share during March 2025 without incurring any capital gain tax liability for the tax year 24-25. Your answer should be supported by appropriate calculation, 4 marks. Read it again. Only calculation is not required, okay? They are asking you first explain how many £1 ordinary shares in N Limited Ginger can sell to her daughter for how much? For £4 per share during March 2025 without incurring any capital gain tax liability. Logically, if your capital gain, either the entire capital gain should be covered by any, I would say, relief. If that is not the case, then logically your capital gain should be equal to annual exempt amount. Either the entire capital gain should be covered by any relief. If that is not the case, then logically your capital gain should be equal to annual exempt amount. Whenever the capital gain is equal to annual exempt amount, then you do not have any CGT liability. Your CGT liability is zero. There are two situations in which there will be no CGT liability. One, there's a possibility that whatever the gain comes, that entire gain is covered by any relief. Let's say if that is not happening, then is there any way where I can have a zero CGT liability? Yes, again it is possible if the gain is equal to annual exempt amount. Now let's read the question. This scenario relates to one requirement. Ginger has holding of 10,000 £1 ordinary shares in N Limited, unquoted trading company. Now stop. If someone is having holding in a private company's shares and you provide that as gift to your connected person, then you can easily get gift holdover relief. Why? Because private companies shares, they are treated as business assets. All the reliefs are available on business assets. So when donor is having shares in a private company, gift of shares in a private company easily qualifies for gift relief, which she had purchased on 13 Feb 2014 for 2.39 per share. The current value of the shares are agreed with HMRC and custom is 6.4 per share. Right now the value is 6.4, okay? But Ginger intends to sell some, not all, some of the holding to her daughter at £4 per share during March 2025. Ginger and her daughter will elect to hold over any gain as a gift of a business asset. For the tax year 24-25, Ginger will not make any other disposal and therefore not utilize annual exempt amount. It means annual exempt amount is available. Now student, try to understand a very important concept. When simply donor is providing gift of shares, no matter whatever consideration you are taking from the donee, number one, for HMRC, the market value will be considered as a selling price, which is 6.4. Repeat. The market value will be treated as selling price, no matter you are getting that amount or not. But there's another concept. What is that? Look at this. If donor is getting the consideration from the donee, which is over and above the original cost. If you're getting the consideration which is over and above the original cost, then the difference between the consideration minus the original cost will immediately result in chargeable gain. And against that chargeable gain, you cannot get any gift relief. Repeat. If there is a disposal of shares at a lower price, it means simply you are providing the gift. Another thing is, if you are getting the donor is getting the consideration from the donee which is over and above the original cost. So any amount which is over and above the original cost, that immediately results in chargeable gain. Now listen, which means that 4 minus 2.39 gives the chargeable amount 1.61 per share. Chargeable gain is 1.61 per share. Now the question is, how many shares can be given as gift without incurring any liability, any CGT liability? So as already given you the concept, then make sure your chargeable gain should be equal to annual exempt amount. Annual exempt amount is 3000. Gain per share is 1.61. So 3000 divided by 1.61. I'm getting almost 1863 shares. So logically, if 1863 shares are sold at $4 to the daughter, then there will be no CGT liability. Number one point which you need to explain is disposal of shares at a lower price means you are providing gift. Second, if donor is getting the consideration over and above the original cost, then additional amount immediately results in chargeable gain. Then you will show the chargeable amount is 1.61, and after that you will have to explain if the gain on number of shares is equal to the annual exempt amount, which is 3000, then there will be no CGT liability. So 3000 divided by 1.61 actually gives you 1863 shares. So if 1863 shares are sold technically to a daughter for £4, it will result in no CGT payable. I hope the entire explanation is clear to everyone. Point number one, I'm just repeating it. You have to just write in your own wordings. First point, you have to explain your examiner that when you are selling shares at a lower price than the market value, it means you are providing gift. Second, if donor is getting the consideration against the gift which is over and above the original cost, then difference immediately results in chargeable gain. Next point, if the chargeable gain is equal to the annual exempt amount, then there will be no CGT liability. Then another point, you will say that 3000 divided by 1.61, it is equal to 1863 shares. If 1863 shares are sold to her daughter, then there will be no CGT liability. So I hope part A explanation, which you have to write in your own wordings, should be clear to everyone. Now let's see part B. Calculate capital gain tax savings. Calculate the capital gains tax saving if disposal of 2000 shares in Cinnamon Limited during March 2025 is made by Innocent rather than Nigel. Read it again. Calculate the capital gains tax saving if the disposal of 2000 shares in Cinnamon Limited during March 2025 is made by Innocent rather than Nigel. So let's see how much CGT can be saved. Innocent and Nigel are a married couple. Both have shareholding in Cinnamon Limited, unquoted trading company, private company with a share capital 1 lakh shares, £1 ordinary shares, £1 is a par value. Innocent has been the managing director of Cinnamon Limited. Innocent and Nigel, a married couple, both have shareholding in Cinnamon. Okay. Innocent has been the managing director of Cinnamon Limited since the company's incorporated in July 2014, and she currently holds 20,000 shares. Now stop. Total shares of the organization, they are 1 lakh, you have got 20. So your holding is actually 20%. One, you are working over there, your ownership period is more than 2 years, plus your holding is more than 5%. So basically it is a personal trading company. When someone sells shares in a personal trading company, then whatever the capital gain comes, that capital gain actually qualifies for better. And when a gain is qualifying for better, then applicable CGT rate is 10%. So here you should be thinking for personal trading company with matching voting rights in the company. With matching voting right means 20,000 shares means you have got 20% holding, you have got 20% voting rights. These shares were subscribed for 1st July 14 at their par value means £1. You bought it for £1, one share. Nigel has never been an employee or director of Cinnamon, and she currently holds how many shares? Only 3,000. With the matching voting rights in the company. These shares were purchased from an existing shareholder on 23rd April 19 for 46,200. Okay. So if Nigel is selling the shares, Nigel will not get the better. Because for Nigel, it is not a personal trading company. Either Innocent or Nigel will sell 2,000 shares in Cinnamon. They just want to sell 2,000 shares. Any one of them can sell. During March 2025 for 65,000. But they are not sure which of them should make the disposal for the tax year 24-25. Both Innocent and Nigel have already made disposal which already fully utilize annual exempt amounts. It means whatever the capital gain comes right now, they will not be getting annual exempt amount. It is already utilized. And they will each have taxable income 80,000 means they are higher rate taxpayer. Okay. Now, we have to solve the question 2 times. One, if Innocent sells, then what happens? And the second, if Nigel sells, then what happens? But don't forget one thing. For Innocent, it is a personal trading company, and whatever the gain comes, it qualifies for better. For Nigel, it is not a personal trading company. So let me show you part B here. Okay. Part B. Innocent CGT payable. Disposal proceed, they have given us 65,000. Innocent bought 20,000 shares, but one share Innocent bought for £1 because Innocent has subscribed these shares. So £2,000 or 2,000 shares into £1. So just the cost is 2,000. There's a chargeable gain of 63,000. Entire chargeable gain is a taxable gain because annual exempt amount is already utilized. But the good thing is this gain actually qualifies for better because for Innocent it is a personal trading company. CGT payable. 63,000 into 10% will give us 6,300. Now, if Nigel is going to sell, don't forget Nigel will not get any better because it is not a personal trading company for Nigel. Nigel CGT payable. Of course, sale proceed, disposal proceed remain same, but cost for the Nigel is different. Nigel bought 3,000 shares from existing shareholders. Disposal proceed is 65,000 less the cost. Nigel bought it. How many shares? Nigel bought 3,000 shares from existing shareholders for 46,200. Now she's selling how many? 2,000 out of that. 46,200 multiplied by 2,000 divided by 3. 46,200 multiplied by 2,000 divided by 3,000. I'm getting 30,800. That gives us the capital gain of 34,200, and the entire chargeable gain is your taxable gain because annual exempt amount they have already utilized. Of course, for Nigel, it is not a personal trading company, so Nigel does not get better. Nigel will be paying 20% CGT because both are high rate taxpayers. CGT payable 34,200, 20%. 20% of 34,200 gives us CGT payable 6840. So if Nigel is going to sell, then CGT liability will be 6840. If Innocent sells, then CGT liability will be 6,300. It means that if Innocent is going to sell, there will be a saving. So for Nigel, why we apply 20%? Don't forget one thing, Nigel is not getting better. Why she's not getting better? It's not a personal trading company. Plus, she will not be getting even investor relief because you did not subscribe the shares. You have purchased the shares. So Nigel is not qualifying for, Nigel gain is not qualifying for better. It's not qualifying for investor relief. That is why applicable rate is 20%. So simply if Innocent makes the disposal rather than Nigel, then CGT saving will be 6840 minus 6300. That will give us 540. So logically, there will be a saving of 540 if instead of Nigel, who sells these, I would say, shares? Innocent. Let me save this PDF and then I'm going to share another question. Let me save this. Okay, students, let's discuss the question. Tony and Anita, I think there was a query on this question as well. This question primarily deals with IHT. And student, if you recall in the previous class, we did the revision of corporation tax and VAT. In today's class, we are discussing CGT Iht. I'll give you one homework on CGT as well. Let's read the scenario quickly. You should assume that today's date is 1st March 2025. Okay, we assume. Tony died on 17 July 2024. Anita was his wife. Okay. Tony had made the following lifetime transfers. Okay. Date, type of transfer, 26 Feb 2016. Potentially exempt transfer, 95. 14th April 16, chargeable lifetime transfer, 120. 10 June 2022, potentially exempt transfer, 5 lakh. Just look one thing. Tony died on 17 July 2024. Tony died on 17 July 2024. And look at this gift. 26 Feb 2016, which is PAT, potentially exempt transfer. Actually, the gap between PAT, which was made on 26 Feb 2016, and the date of death is more than 7 years. If it is more than 7 years, then PAT becomes fully exempt. On the death of Tony, 95,000 will not become chargeable. Why it is not becoming chargeable on the death of Tony? Because the difference from the date of gift and date of death is more than 7 years. That is why now it is fully exempt. Now look at the second gift. 14th April 2016, chargeable lifetime transfer. If you count the gap between 14th April 2016 to the date of death, it is again more than 7 years. Now listen, I want to say something. If it is more than 7 years, then on the death of Tony, on this 120, we will not be paying any death tax. Why we are not paying any death tax on 120? Because the difference between chargeable lifetime transfer and the date of death is more than 7 years. That is why on 120, on 1,20,000, we will not be paying any death tax. Okay. But look at this last one, 10 June 2022. Potential exempt transfer is 5 lakh. This date of gift and death. So basically from the third gift till the death date is within 7 years. So basically this PAT of 5 lakh becomes chargeable on the death of Tony. Okay. The potentially exempt transfers and chargeable lifetime transfer are after taking account of no need to deduct any annual exempt amount from this 95,000, from this 120, from this 5 lakh. They have already deducted. Look at the first requirement. How much IHT was payable in respect of the potentially exempt transfer of 5 lakh made on 10 June 2022 as a result of Tony's death? So obviously on Tony's death, logically 5 lakh becomes chargeable. So let's try to calculate. We are actually calculating death tax. Entire 5 lakh becomes your gross. Now it becomes chargeable amount, entire 5 lakh. Transfer of value. Nil rate band. 3,25,000. Now listen carefully what I'm writing. Less last 7 years gross chargeable transfer. What I'm writing there is very important. Prior to death. Nil rate band is 3,25,000. From this 325, we will deduct last 7 year gross CLT. No, prior to gift. Prior to gift. My bad. Prior to gift. Just a minute. Prior to death, we only write when we are calculating CGT on death estate. Less last 7 years gross CLT prior to gift. This gift was made on 22nd on 10th June 2022. If you go 7 years back from this gift date, you will find one gross chargeable transfer which is 120. Let me read again for you. Nil rate band is 3,25,000. After that, what I'm writing, less last 7 year gross CLT prior to gift. So we do have one gross CLT 1,20,000 which is prior to this gift. So from 3,25,000, we will deduct this 120, we'll get nil rate band of 205. Now some of the students, they just get confused. They say, sir, why if you're taking 120, why you're not taking 95? You're forgetting one thing. 95 is not a gross chargeable transfer, number one. Number two, on the death of Tony, 95 is not becoming chargeable as well. So 95 was not chargeable. Plus, on the death of Tony, 95 does not become chargeable because the gap between 95 pat and death is more than 7 years. But story of 120 is different. What I'm writing, read it again. Nil rate band 320 less last 7 year gross CLT prior to gift. 120 falls there. So 5 lakh minus 205 will give us taxable gain 2,95,000. Of course, death CGT rate is 40%. Taxable amount is CGT rate 40%. IST rate, not CGT. IST at 40%. Why I was saying CGT? Because we were practicing CGT, so that is a slip of tongue. IST on death tax is 40%. IST on death estate is 40%. So 2,95,000, take 40% of that, it gives you 1,18,000. This is what we need to calculate. Let's come here. How much IST was payable in respect of the potential exempt transfer? It is 1,18,000. Now the question is, why we are not thinking about taper relief? Actually, taper relief is only available when donor survives at least 3 years. Otherwise, you will not get taper relief. If you look at the date of gift, which is 10 June 2022, and the date of death is 17 July 24. So basically, from the date of gift and death, the time period is not actually, it is within 3 years. It's not 3 years some plus. So donor has to survive at least 3 years, to get taper relief. Since the death is within 3 years, that is why taper relief is not available. Okay. So the maximum IST which will be 1,18,000. So the answer is part B. Now, second, what is the amount of inheritance received by, let's say, Maruti, something like that. So apologies if the pronunciation is not correct. Let's see. Oh no, that is fine. What is the amount of inheritance received by, let's say, Maruti? Maruti. Tony left an estate valued 1.6 million pounds. Wow. For IST purposes, as the nil rate band has already been used, IST was payable on chargeable estate. Under the terms of his will, Tony left 4 lakh to his wife. Now listen, student. Husband and wife, exempt party. So gift to exempt parties, gift to wife is an exempt amount. Anita, specific legacy 1 lakh to his brother. Residue estate to his niece Maruti. In Maruti's will, she will leave her estate to her children. So whatever Maruti gets, Maruti says, I will write in my will that after me, my children will get my estate. Okay. But right now the question says how much Maruti will get. So let me explain here. It's very simple. Death estate is 1.6 million. 400,000 is given to Anita, exempt party. Exempt amount to wife is 4 lakh. So 1.6 million minus 4 lakh will give me 1.2 million, means 12 lakh. Of course, entire 12 lakh is a chargeable estate. IST is 40%. If I take 40% of that, I'll get 4 lakh 80,000. After paying 480, how much will left? 1.2 million minus 4 lakh 80, I'll get 7 lakh 20,000. 720 is left after paying IST. Then the question says a specific legacy 1 lakh to his brother. Tony says 1 lakh should be given to my brother. So let's deduct the specific legacy. Specific legacy to brother. 1 lakh. So we have paid IST, we have given specific legacy to brother. Whatever is left residue is for Maruti. So 7 lakh 20 minus 1 lakh will give us 620. This is the entire amount 6 lakh 20, which is for Maruti. Part D. Residue is for Maruti. Husband and wife, they are exempt parties. After that, we got chargeable gain 1.2 million. On that, we paid IST of 4 lakh 80. After that, we deducted specific legacy to brother. Whatever is left that relates to Maruti, which is 6 lakh 20. What would be the IST implications have been if under the terms of his will, Tony had left part of his residue of his estate to Maruti's children rather than leaving entire residue to Maruti. Now listen carefully. Let's say Tony provides gift to Maruti. Maruti is Tony's niece, okay, chargeable person. On the death of Tony, on chargeable estate, IST will be paid. Repeat. Who will pay that? Maruti, because Maruti is a donee. Let's say Tony says my death estate should be given to, for example, Maruti. Fine. Maruti is Tony's niece. So it means on the death of Tony, there's a charge, there will be a chargeable estate on which IHT will be paid. Then Maruti will leave the death estate for her children. Now, on the death of Maruti, her children will be paying IHT. So logically, there will be double IHT. First, IHT will be paid on the death of Tony by Maruti. Then on the death of Maruti, children will get the inheritance. And on that inheritance, children will pay IHT. Now, if Tony skips one generation, instead of giving death estate gift to Maruti, if Tony directly gives gift to the children of Maruti, then in this way, logically, you are skipping one generation. When you are skipping one generation, then you will be saving IHT, because when Tony provides directly gift to her niece children, inheritance to her niece children, then on the death of Maruti, it will have no impact on Maruti's children. So basically, the benefit is IHT will be safe due to skipping the generation. Let's see what they are saying. It would have reduced the amount of IHT payable in respect of Tony's estate. No, it will remain same. It would have removed the potential for a double charge IHT before Tony's estate inherited by. This is the point. If you skip the generation, there will be no double IHT. It would have reduced the potential IHT payable when Maruti's children die. No. It has nothing to do with Maruti's children's. It would not have resulted in any IHT saving either Tony or wrong. So logically, part B is the right answer. By skipping generation, you will be actually saving what? IHT. There will be no double IHT then. If Anita were to die on 15 March 2025, if Anita were to die on 15 March 2025, how much IHT would she have saved as a result of making the cash gift 6 lakh to Maruti on 20th August 2020, rather than retaining this cash until her death? If you keep that cash until her death, then on death estate you have to pay 40%. But if you give that 6 lakh as gift on 20th August 2020, so first it will be pat during the lifetime. During the lifetime, this 600,000 is pat. There will be annual exempt amount of current year 3,000, last year 3,000. We'll get 5,94,000. Logically, 5,94,000 becomes taxable if donor dies within 7 years of the gift, and it is happening. If Anita dies on 15 March 2025, the time period from 20th August 2020 till 15 March 2025, it is within 7 years. So now death tax. 5,94,000. Nil rate band. Is 3,25,000. Okay. Less last 7 years gross CLT prior to gift. Let's read the question. Do we have any CLT? Anita made a cash gift of 6 lakh to her niece Maruti on 20th August 2020. This figure is before taking account of any annual exemption. Anita had already made a chargeable lifetime transfer on this, which will fully utilize her nil rate band. So basically, nil rate band is not available. It is already utilized. Entire 5,94,000 becomes taxable amount. IHT is 40%. If you take 40% of 5,94,000, you will get 2,37,600. Now, let's think for a taper relief, because if donor survives at least 3 years, then taper relief is available. Date of gift is 20th August 2020 and date of death is 15 March 25. It means August 21 is 1 year, then August 22 is the 2nd year, August 23 is the 3rd year, August 24 will be the 4th year, and then it is not August 25, before that she dies. So it is somewhere between 4 to 5. 4 to 5, taper relief is 40%. And rate and percentage of taper relief, they are given to you in exam. Less taper relief. 4 to 5 years. If I take 40% of 2,37,600, I'll get 95,040. So logically, Iht payable is 1,42,560. So if it was cash was given as gift during the lifetime, it would, then on death tax there will be Iht payable 1,42,560. Instead of this, if Anita leaves entire 6 lakh on her death estate, then Iht is 40%. Nil advance is already utilized. If you take 40% of 6 lakh, you will get 240. Now listen. If Anita gives 6 lakh as gift during her lifetime, then Iht will be 1,42,600. If Anita leaves this entire 6 lakh in her death estate, then tax Iht will be 240. So how much Iht will be safe if given as gift during the lifetime? Iht saving 2,40,000 minus 1,42,560. 2,40,000 minus 1,42,560 gives us the saving of 97,440. So Iht saving is 97,440. Let's see. Okay, share. If Anita were to die on 15 March 2025, who would be responsible for paying Iht arising from cash gift to Maruti? On 20th August 2020. And when would this Iht be due? A very important point. Iht on death is actually paid 6 months after the month of death. So first of all, leave the month of entire March, then go 6 months ahead. So Iht on death is actually paid on 6 months after the month of death. So if I leave the month of March, count from April. April, May, June, July, August, and September. It's going to be 30th September 25. And who will pay? Of course, the Maruti will pay. If Anita were die 15 March 25, who would be responsible for paying? Dhoni will be responsible. And who's the Dhoni here? Maruti. So basically, Iht will be paid 6 months after the month of death by the Dhoni. So students, that was all about a question on Iht as well. Again, if you want any questions from the entire Kaplan kit which you want me to discuss, I'll be more than happy to conduct the live class to discuss that question with you. And plus, I'm giving you the homework as well. And let me tell you the name of a question. And admin will, I think, either today, otherwise tomorrow, they will send you the message in which we will explain the entire pre-scene mock when you are supposed to attempt and when we will be discussing the debrief on that ACCA pre-scene mock. Students, I hope you can see this. Question number 178. I think Diljit is the name of a question. Take it as a homework. I really want every one of you to solve it by today. And in case of any queries, you can always ask the question in your relevant WhatsApp group. I strongly believe that you have enjoyed today's class. If you have any queries regarding these questions, any other question from the entire Kaplan kit, you are more than welcome to ask in your relevant WhatsApp groups. So thank you very much and hope to see you all and others in the coming live revision classes as well. Thank you.